Hey, what's going on, guys? Welcome back to the channel. And on today's episode of Things School Didn't Teach Me, we're going to be going over all the steps that it takes to buy a house. In today's crazy market where the average house is $350,000, which is 7 times more than the average income, it's stressful enough trying to find a house that fits your budget. So if you're looking to buy a house now, your process should have started a while ago, and that's when you start saving up for a down payment. Well, a down payment is a portion of the mortgage that you're going to pay, or a fancy word for home loan, that you're going to have to pay up front to the bank. There's a few different types of mortgages used to buy a house, and that will depend on how much down payment you'll need. The two main mortgages that everyone usually uses is the first one, which is FHA, and the second one, which is a conventional type of mortgage. The first type of loan that I mentioned, which was an FHA loan, allows you to put down as little as 3.5% down. So if you're buying a $100,000 house, all you need is $3,500 down towards that down payment. FHA loans are usually easier to get because they allow lower credit scores and allow you to put less money down. The reason why these loans are much easier to get into is because these are backed by the government or the Federal Housing Administration. On the other hand, we have conventional loans, which are more private, coming from banks and credit unions and things like that. These are usually harder to get into because they're not backed by the government themselves. If you're going to go the conventional route, you're able to put down as little as 3% down on your down payment, but this is only for first-time home buyers. On the other hand, you usually want to put up to 20% down. Because no matter what your loan is, whether it's a FHA loan or whether it's a conventional loan, if you don't put 20% down on your loan, you're going to be paying something called PMI, or private mortgage insurance. This is basically an extra recurring fee that goes on to your monthly payment every month. Depending on how big the mortgage is, it could be $100, could be $50, could be $150. Usually FHA PMI is higher than conventional. So with an FHA loan, if you're putting down less than 10%, you cannot get rid of this PMI insurance unless you refinance or get a different loan. On the other hand, with conventional, if you put 3% down, if you put 5% down, if you put 10% down, that PMI will stay on your mortgage payment until you reach 20% equity. So once you understand the different types of loans, or you have an idea on what the different types of loan is, because there's a lot more that goes into these loans, you want to find your team. Team consists of two major players. One is the loan officer, who's going to know all the details about the loans and know how to get you a loan. And the second one is your go-to guy, or your real estate agent. It's critical to have very, very good loan officers and very, very good real estate agents because, like I said, there's so much to know about home loans that you can't know it all. And if you're going to try to figure out every single detail, it's going to make things much more complicated. So a good loan officer will be able to explain all the payments that go into a loan. They'll be able to work with your real estate agent and figure all the details out. Now, on the other hand, I think the most important person to your team is your real estate agent. Your real estate agent should be your go-to guy. This is the person that's going to be showing you houses, that's going to be doing the negotiating with the sellers, that's going to be writing up the contracts, telling you the details about the house, and so much more. There are multiple ways to find a real estate agent or a loan officer that can work for you. One way is if you have a loan officer, ask him if he knows a real estate agent. If you have a real estate agent, ask him if he knows a loan officer. You can continue that and ask your family members, friends, which real estate agents or loan officers they used. Make sure you find one who's reputable and actually knows their job and can help you throughout the process. You don't want to deal with a real estate agent who's not going to know the area, not going to know how to negotiate with sellers and so on. Because real estate agents work off commission, one thing they're going to want before they work with you is pre-approval from your loan officer. This pre-approval basically says, from your loan officer, I've looked into the client's numbers, I looked into their income, what their credit score is, and so much, and they're approved for, let's say, $400,000. Now the real estate agent knows that you're approved for $400,000, so they can show you $400,000 houses. They're not going to want to show you $2 million houses knowing you're not approved for that, because like I said, they work strictly off commission. So if they don't sell you something, they're not making any money. The cool thing about real estate agents is if you're the buyer or looking to buy the house, the seller is the one who usually picks up the cost of the real estate agents, and this is for their agent and your agent. They pay for these in the closing costs that we'll get into a bit later. One detail about getting pre-approved by a loan officer is, like I said, if they pre-approve you for $400,000, that does not mean that you should go and buy a $400,000 house. These loan officers usually approve you for more than which is realistically in your budget. So according to the numbers like your credit score, your debt to income ratio, things like that, and your income, you may be able to afford a $400,000 house, but is that taking into account utilities, maintenance, your cars, everything like that? There's a lot more that goes into the numbers, so I'll also teach you how to run those numbers. Now, there's millions and millions of houses out there, I think. I mean, they say we're in a house shortage, but anyways, there's a whole bunch of houses for you to look out there. So where do you even start? How do you start finding houses that you like or that you want to go and take a look at? Well, the first way is talking to your real estate agent. They will set you up with the MLS, or the multiple listing service, which is basically the place where selling agents list all of their things or all of their properties. Once this, you'll get reoccurring emails every week, couple days, and you could take a look at what houses are on the market, how much they're selling for, what the area is, and what their details are. Another way to find houses is listing services like Zillow, Redfin, and so much more that are online. So say you're looking at your MLS or you're looking on Zillow and you find a house that you like. You'll send this to your real estate agent and they'll set you up with a private showing. This private showing is something where they can take you, they can walk you through the house, you can see the ins and outs about the house, they can give you all the details, check out the area. The other type of showing that there is an open house. An open house is exactly what it sounds like. It's an open house. So if there's someone selling their house, they'll have their real estate agent put a sign up front saying, come on in, and they'll open this house for everyone to see. You have an idea on who to have on your team. You have an idea on what goes into buying a house, but you have no idea on how much you can actually afford. So let's take a look at the numbers. So once you find a house, you need to know how much to offer. Usually you can offer above, you can offer asking, or you can offer below asking. Obviously, if you're offering less than the asking price, it's less likely for you to get the house, especially in this market. But say you do find a house and you want to put in an offer. How much should you offer? Well, that depends on two things: the comparables and the budget. What's a comparable? Well, a comparable is exactly how it sounds. Your agent will take a look at the comparable houses in that neighborhood or in that area with the same square footage or around that same square footage, same types of bathrooms. The house you want is a 2-bathroom, they're going to be looking at other 2-bathroom houses. If it's a 3-bedroom, they're going to look at other 3 bedrooms. If it's a ranch, you're going to be looking at other ranches. They want to find houses in that market that are similar to the house you're interested in to see how much they sold for. Basically what the house is worth. So that's the first step in figuring out how much you should put in an offer on a house. The second step, like I said, is knowing your budget. Obviously there is no set rule on how much house you can afford, but the rule of thumb that people say is 33% of your gross income pay, which is your pre-tax pay. So if you make $100,000 salary, they say your housing costs for the year should not cost more than $33,000. I like to follow a different rule because they use gross pay, and gross pay doesn't pay the bills. What pays the bills is net pay, or after you get taxed. It's hard to find houses that will actually meet that criteria nowadays, so use it as a guideline and not a set rule. The cost that you should take in consideration is more than the mortgage payment. So if you want to buy a house, don't say, oh, the mortgage payment is 30% of my net pay, let me buy that. No, because that's not all that goes into a house. There's a lot of phantom costs that you really don't expect, or things that you won't really account for until you get into the house. So add a little buffer for that. So if your mortgage is $1,000, you want to budget property taxes. You can find your property taxes by going on your city's website and taking a look at that. You want to take into account your interest rate. There's a mortgage calculator on Zillow that you can put in your interest rate, your down payment, how much the house is going to cost, and it'll come up with a total mortgage payment. You're going to want to take a look at if you're paying PMI or the private mortgage insurance. Other things like utilities, your electricity, your gas, your water bill, things break down, furnishing the place, all these you have to take into account. And if you can, that number should be around the 30 or 35% of your net pay. So once you found the house you want, how do you make an offer? You're going to text your agent, you're going to email your agent, call them, whatever you want to do. Get a hold of your real estate agent, tell them, I want this house at 123 Main Street and I want to buy it for $250,000. I'm going to include a 10% down payment. I'm going to be using a conventional loan, and I'm going to have earnest money of $5,000. So what's earnest money? Well, earnest money is basically a part of your down payment deposit. Once your offer is accepted, you pay to the seller that will be held in escrow or a third party, which basically tells them that I'm serious about this property. In some cases, if you back out, they'll keep that money, but I'm going to teach you how to get that money back. You can get that money back by adding contingencies to that offer. Well, the two types of contingencies are an inspection one and a financing one. The financing one is basically saying, if I can't get this money, I'm allowed to back out and I want my earnest money back. The second one is the inspection one. This says if I go and get an inspector in this house within the next 3 or 7 days or a day period that you guys agree on, and I find a big crack in the foundation that's going to cost me $50,000, I want to back out. Or if I find out that the furnace doesn't work and I'm going to need $10,000 to repair it, I want to back out and you can get your money back. So like I said, earnest money is something that you pay up front to the sellers to show that you're serious, but make sure you're talking to your real estate agent about the contingencies to protect yourself if you want to back out. Earlier, I did mention that there are two parties that you need on your team, a real estate agent and a loan officer. Well, the third one you need is an inspector. An inspector is someone that you hire, a third party, that will take a look at the house. They'll see how the foundation is, how the roof is, how old the windows are, and basically the overall condition of the house. They'll then give you a 20 or 30 page report with pictures on the house, giving you an idea on whether you should proceed or whether you should back out. But in the end, it's up to you whether you want to move forward or not. So these are a few things that go into buying a house. Remember, buying a house is not an easy process. It takes a lot of money, and it's one of the biggest financial decisions you'll make in your life, especially when you're younger. But now that you have a better idea, if you have any questions, drop them in the comments below. Make sure to like the video, subscribe to the page, as it really does help support the page, and we'll see you guys in the next one.